Want to learn the essential life and health insurance topics quickly? This slides guide is packed with high-priority points to help you study smarter, not longer. Now, let's dive into general insurance concepts. What is insurance? When we talk about insurance, we're really talking about managing risk. Instead of facing a big financial loss on your own, you pay a premium to an insurance company. In return, the company promises to cover certain losses. Think of it as pooling resources with many other people. For example, if 100 people each pay a small amount, the company can cover a large loss if one person gets hurt or sick. This is the fundamental idea behind insurance. It's all about sharing risk so no one suffers alone. The parties in insurance. There are three key players in insurance. The first is the insurer, the company that takes on the risk, collects premiums, and pays claims. Then there's the insured, the person or business being protected. And finally, there's the broker. Unlike the insurer, brokers represent the client, not the company. They help people find the best coverage from multiple insurers. It's important to remember that a broker's job is to act in the client's interest, helping them navigate the often confusing world of insurance. How insurance companies operate. Insurance companies are complex organizations with different departments that keep the business running safely. The actuarial department is responsible for calculating premiums, reserves, and sometimes dividends. They use mathematics and statistics to ensure the company can meet future claims. The underwriting department reviews applications and decides which applicants to accept or decline, assigning risk classifications to protect the company. Then there's the claims department, which investigates and pays claims to make sure policyholders are compensated fairly. Each department plays a crucial role in maintaining the company's financial stability. Types of insurers. Location of incorporation. Insurers can be classified in different ways. By location, a domestic insurer operates in its home state. A foreign insurer is licensed in one state but operates in another. An alien insurer has its. Knowing where an insurer is domiciled is important because it affects which laws and regulations apply. Types of insurers. Authorization status. Another classification is by authorization status. An admitted insurer is fully licensed by the state and holds a certificate of authority. These companies are regulated and must follow state rules. A non-admitted insurer does not hold a state license and typically provides surplus lines coverage for unusual or high-risk cases. The key difference is that admitted insurers are safer for consumers, while non-admitted insurers are used for specialized or unusual risks. Types of insurers. Ownership. Ownership affects how insurers operate and how profits are distributed. Mutual insurance companies are owned by their policyholders. Policyholders can receive dividends and vote for the board of directors. Stock companies are owned by shareholders, issue non-participating policies, and profits go to the shareholders. There are also reciprocals, which are groups of members insuring each other, fraternal benefit societies for non-profit or group-specific coverage, captive insurers created by a parent company to cover its own risks, industrial or home service insurers specializing in small weekly policies, and Lloyd's of London, which is actually a marketplace for unusual risks. Multi-line insurers provide multiple types of insurance under one roof, offering convenience and bundled coverage. Alternative risk and special insurance markets. Sometimes, insurers manage risk in alternative ways. Reinsurance allows one insurer to transfer some risk to another company, letting them write more policies without overexposing themselves. Risk retention groups are liability insurers owned by their members, spreading risk within a specific group. Some businesses or individuals act as self-insurers, setting aside funds to cover their own losses. Surplus lines insurance comes from non-admitted insurers and covers unusual or high-risk situations that regular insurers won't touch. For instance, a nuclear power plant might need a surplus lines policy because no standard insurer would cover it. Reinsurance is when one insurance company transfers part of its risk to another company, called the reinsurer. This works the same way individuals use insurance to manage their own financial risk. Reinsurance provides key benefits. It protects insurers from catastrophic losses. It allows them to issue larger policies. It helps stabilize the overall insurance market by spreading risk. For example, ABC Insurance writes a $10 million homeowners policy. To reduce its exposure, it transfers $7 million of that risk to XYZ Reinsurance and keeps $3 million. If a major loss occurs, ABC only pays $3 million, while the reinsurer covers the rest. This keeps the company financially stable and able to write big policies confidently. Dividends and surplus participating policies are usually from mutual companies, giving policyholders the potential to receive dividends and vote for the board. Non-participating policies, typically issued by stock companies, do not pay dividends, and profits go to shareholders. The divisible surplus is the portion of the company's earnings available for distribution after covering reserves and expenses. It's important to understand that dividends are not guaranteed, they depend on the company's financial performance. Chapter Summary. In summary, insurance is a way to transfer risk and protect against financial loss. The main players are the insurer, the insured, and the broker. Insurance companies operate through specialized departments like actuarial, underwriting, and claims. Insurers are classified by location, license status, and ownership type. There are also specialized markets such as reinsurance, risk retention groups, and surplus lines. Finally, financial concepts like participating policies and divisible surplus determine how profits or dividends are shared. Understanding these basics gives you a strong foundation for studying life and health insurance.